Welcome to Trading Basics Part 2, Lesson 6, Income Tax and Stock Market Gains. Understanding taxation and making proper tax payment is an integral part of successful management of our investment. In this lesson, we want to teach you a few important tricks in terms of managing tax in investment. In the last lecture, we talked about dividends. Here, we will explore the concept of taxation on the gains and loss made from stock market investment. Here's a kind of upsetting fact we need to admit. Sometimes your income tax can go as high as 40%, while the big corporation tax doesn't even exceed 15 to 20. Some say it's because capitalism encourages small business owner to create businesses by tax them less. But how many small businesses actually have the ability to compete with the big guys? It seems in reality, in North America, tax laws are designed to benefit big corporations to make more money. This seems a bit ironic and unjust, given that tax should be collected to mitigate or minimize the disparity between the rich and the poor. But we argue that everything here in North America or corporate America is designed for you to pay less tax if you invest in the stock market. This means that the system is encouraging you to give your money to the corporation first to pay less tax, and second, to make more money as stock gets more expensive. Making earning in stock market is taxed similar to any other earnings as part of your income. However, we need to know what earning in stock market we are talking about. Stock is an asset, similar to your house. If your house value goes up, you have to pay capital gain tax for any value appreciation of your asset. Capital gain tax in North America is calculated based on half of the price appreciation of that asset and added to your personal income tax. For example, if your stock price per share goes up from $100 to $120 per share, then you have $20 share asset value appreciation per share. If you hold 100 shares of the stock, you will have 2,000 capital gain. Divided this value by 2, this gives you $1,000, and if you add this to your taxable personal income, you will have the full personal income that you'll be taxed on. The last slide, we discussed the tax you have to pay for stock value appreciation. The story is quite different when it comes to dividend tax. Dividend paid by a company is not an expense of that company, but rather an income of the shareholder. The tax treatment of this dividend income varies considerably between countries. For instance, in the US and Canada, they impose a lower tax rate on dividend income compared to ordinary income, on the assertion that company profits have already been taxed as corporate tax. This rate can vary between 0 to 30% depending on your personal income tax bracket. Meaning, if your personal income tax is in a lower income bracket, you may not even be asked to pay dividend tax. As your income tax classification goes to higher brackets, your dividend tax also rises from 0 to over 30%. But as you can see, even 30% is still significantly lower than the highest income tax bracket, which could sometimes reach 45% at above, let's say, in Canada. For the accurate percentage of dividend tax, refer to a certified accountant. If you are a Canadian resident and are eligible to open a tax-free savings account or TFSA or a retirement savings account or RSP, you don't need to pay a dime as tax to the government for any profit earnings you might have. In case of TFSA, you will never pay tax on your earnings. In your RSP account, you will only pay tax if you ever decide to take your money out of the registered RSP account, which could be any time between now and a time of your choosing in the future. It is important for us to understand the intricacies on taxations for the following reasons. First, all trade gains and losses must be reported to the state tax collection agency accurately. You need to either hire an accountant and pay him a lot of money to calculate all your annual capital gains or losses and dividend payouts, or you may want to do it yourself and then report the final numbers to your accountant. Or you can also plug them into your tax calculation software yourself. But either way, someone needs to make sure that all these gains and losses for every trade you have made is calculated and added up to be reported to the state collection agency or state tax collection agency accurately. Second, we need to be smart. We need to know the intricacy in order to learn to minimize tax payment. Knowing what pays less tax will allow you to allocate your capital more skillfully or efficiently to different accounts so that you can avoid paying unnecessary tax. Perhaps you want to make sure that your TSFA and RSP accounts are fully utilized first. Then you may want to use your marginal cash account. Or you might want to only invest in high dividend paying stocks to enjoy the less tax earning that you would make through dividend investment. You need to file your gains and losses in the stock market along with any other income you have annually to the government. So it is important that you keep clean record on a monthly basis on your gains and losses so that you don't get overwhelmed at the end of the fiscal year. Sometimes brokers send you a detailed annual report where you can see exactly what you bought or sold, when you bought or sold, or how much you bought and sold for the entire year. Then you may need to spend a chunk of your time to go through the list and calculate all the wins and losses. Now comes the good news for stock market investors. In the stock market, if you end up losing for a year, you can report your loss and carry it over to the next year. If in the year following the bad year, you finish the year with gains, then losses from the previous years cancel off part of the gains in the new year. Of course, that depends on how much you lose and how much you gain. In the US, the capital loss can be carried forward indefinitely, whereas in Canada, this is true for only 20 years. You can even carry back your capital losses. For example, unused 2017 net capital losses can be carried back to 2014, 2015, and 2016 if you have not filed them. As you can see, it seems that the stock market investment gains are among the least taxed earnings that you can imagine, certainly less than personal income that you make in your daily job as an employee. This is yet another reason for you to pick this form as an investment over other traditional investment strategies. Coming up next, we'll talk about fundamental analysis and its significance for your investment planning. I hope you all enjoyed the video and that you have a better understanding of taxation and how to avoid paying unnecessary tax on your investment. For more educational materials, always go visit www.marketnewbie.com, leave a question or comment on our Facebook, YouTube, or Instagram pages. See you in the next lecture.